Sequence of returns risk can derail our retirement sooner than expected. What happens when your train to retirement gets derailed? Retirement is a long game. Some of the most frequent questions asked by investors looking at retirement include these. How long does our retirement income have to last? Will we outlive our savings? What happens if there is a market downturn around the time we plan on retiring? What happens if we need extra money for emergencies? It is important to not only protect the health and safety of our loved ones, but also to safeguard our own financial future. The uncertainty of financial markets and the broader economic picture raise concerns for those in or nearing retirement. Fast forward to the point in time that we approach retirement. We have been disciplined enough to put aside money each month and have done a good job in accumulating a tidy nest egg. While it's well done, it's still not job done. By understanding retirement risks and the financial landscape, we can plan for a more secure future. Are we confident that this retirement pot can last our entire retirement? What is one of the biggest risks which no one anticipates but can have significant impact on our retirement? A very important but least understood and gets very little attention and is a big retirement risk is sequence of returns risk. Sequence risk is the danger that comes in which poor market returns occur after the accumulation stage ends and when the distribution stage from our portfolio begins, and that the timing of withdrawals from a retirement account will have a negative impact on the overall rate of return available to the investor. If the financial market plunges at about the same time you retire or during your early retirement years and start taking regular withdrawals from your primary investment account, you could be in for a big financial shock and reduce the longevity of your portfolio. Market performance varies year to year, and during the years we are building our nest egg, this is not as much a concern since we can afford to survive the market ups and downs. This can be potentially harmful to retirees' savings and can really throw the best laid retirement plans off track because they usually need to take money out of their accounts for income regardless of what the market is doing. What goes up must come down. It is not about how safe the market is or how well the market is performing in the long run. It is about the timing of withdrawal. Timing is everything, and in retirement, this is a serious risk because suffering a loss during the first 10 years leading up to our retirement and the first 10 years after we retire can significantly reduce the longevity of a portfolio. Particularly if they are paired with rising inflation, it can greatly reduce the chances our money ever lasting our lifetime. Sequence of returns risk is a significant threat because during this transition phase from being employed to being retirees don't have much time to make up for losses, and making withdrawals during a down market only compounds the issue. Retirement risk zone. Sequence of returns risk takes center stage with markets down. The retirement risk zone is the critical period leading into and just after retirement, when the retirement nest egg is most vulnerable to market downturns. That is 10 years before and 10 years after retirement. Retirees or those who are considering retirement need to be very careful about taking too much risk in their portfolios when they are drawing income. The combination of market losses and income withdrawals can dramatically increase the risk of running out of money. To better understand the sequence of returns risk, let's consider this example. Two investors, Mr. Smith and Miss Jones. Mr. Smith, represented in brown color, retired in 1969, and Miss Jones, represented by blue color, retired in 1979, 10 years later. The 10-year difference in their dates of retirement had a significant impact. Both invested in a mix of stocks and bonds, withdrawing 5% per year initially, then increasing the percentage withdrawn each year to keep up with inflation. Mr. Smith experienced negative returns in 4 of the first 10 years, as well as elevated inflation rates. Although his rate of return was higher at 10.5% compared to Miss Jones' 9.6%, the combination of lower returns in the beginning of retirement and high inflation caused the inflation adjusted exhaustion of Mr. Smith's portfolio after just 15 years. Miss Jones, on the other hand, experienced negative returns in only 2 of the first 10 years in retirement. Although she also experienced periods of high inflation, timely positive market performance helped to grow her assets in the early years, and a strong bull market helped the assets continue to grow as she took income from the portfolio. The main difference between these retirements was that Mr. Smith had the misfortune to retire at the wrong time. Sequence of returns risk in national pension system. When applied to NPS, sequence of returns risk causes a unique problem that does not exist with other products usually used for retirement planning. What if the stock or bond market falls just before the national pension system corpus matures at 60 years? This particular problem is unique to NPS since generally the corpus becomes eligible for withdrawal at 60. The problem happens if the following two conditions come true together at the same time. There is a fall in either equity or bond markets just before age 60, and you do not have any other corpus outside NPS to allow you to defer NPS withdrawal in the hope the fall will recover. Why the current 2 to 3 years have been a dangerous time to retire? For someone who has retired in these past 2+ years, sequence of returns risk poses a high risk of depletion of their retirement funds sooner than expected. If we are planning for a 30 to 40 years of retirement, these first few years could be really important in terms of what we end up experiencing for our outcome. Sequence of returns risk can make or break our plans of becoming and remaining financially independent or retired. The importance of this factor has never been greater in the current context, one where the COVID-19 pandemic has resulted in a global market meltdown, combined with the war in Ukraine, and now the looming danger of global recession in 2023. Ignoring these factors could spell big trouble and create an unknown risk for our retirement plans. Retirees face significant risks, especially when experiencing substantial early losses in their portfolios. These losses can rapidly deplete the value of our investments and have long-lasting effects on their retirement plans. It's a scary time for new retirees. Under the current scenario, High inflation means retirees need to draw more income to afford the same items and make ends meet. That's a pretty bad combination. But there are antidotes to this unfortunate timing. One, of course, is to delay retirement. But if that's not realistic, we may have to build a substantial balance during our working life. But will it provide the lifestyle we desire throughout our retirement? We might have plenty of money for a 10 to 20-year retirement, but what if we survive for 30 to 40 years? What are we going to do? And even if we have enough now, does our portfolio have time to recover from a bad year? What about 3 bad years? And what's the effect on our portfolio if we rely on it for income and have 3 bad years in a row? Sorry. Before I conclude, sequence of returns risk is the most underappreciated for dangers of investing. If we do not recognize, understand, and account for sequence of returns risk in our investment planning, chances are we would be in for a rude shock. For the withdrawal phase, we will have to account for this explicitly. It may not be possible to entirely avoid sequence risk when preparing for retirement, but by thinking ahead, we can insulate our portfolio from it as much as possible. May the force of positive impact on retirement income returns be with you. Please go through the description for the sources for this presentation. I've shared the link to my next presentation, how to find an LGBTQIA plus friendly insurance advisor, at the end of this presentation. And do not forget to check out the playlist for more presentations. If there is something to gain and nothing to lose by asking, by all means ask. Thank you for taking the time to watch this presentation. I sincerely appreciate it. Namaste.